And joining us again for more analysis on the jobs report is Bloomberg Best economist Scott Brown from Raymond James. Also, I want to welcome another Bloomberg Best economist, the chairman and chief investment officer of Hugh Johnson Advisors. Hugh, thanks so much for joining us, both of you. And I mean no disrespect, but both of you, as well as several others that we talked to, did not expect a number like this. Hugh, how much of a blow is this going to be for the markets?
Short-term and long-term are two different things. Short-term, it's going to be, we're going to give back some of the gains we've had more recently, and you're going to see within the market itself, you're going to see the sectors that have been doing well, such as cyclicals, industrials, and technology, probably be on the downside, and the safer sectors like healthcare, consumer non-cyclicals, and utilities will be the leaders. But that's only on a short-term knee-jerk reaction. Keep in mind what this has led to. This has led to a sharp decline in the dollar, a sharp decline in interest rates, which is part of the Federal Reserve's strategy. Maybe they won't confess to that strategy, but it's a part of the strategy, and that's good news.
What do you mean it's a part of their strategy?
Well, what I'm saying is that the QE2, the strategy would be to put downward pressure on the dollar, although they would not confess to that, would to be keep interest rates low. And what that's likely to lead to is an increase in exports, preserve inflation, an increase in bank lending, and an increase in money growth. That's really a sound strategy. So I think on a longer-term basis, the reaction in the market, the reaction in the dollar, the reaction in interest rates is likely to be helpful for that strategy. So short-term, yes, knee-jerk reaction on the downside, cyclical sectors downside, safe sectors upside. But on a longer-term basis, it's probably fairly good news. In other words, this bull market is still going to be fine.
Okay, so what I'm hearing is that basically this puts in place firmly the need for the Fed to continue and complete QE2, right, Scott?
Yeah, I'd have to agree with that. I think all else equal, you'd probably want to see more fiscal stimulus at this point, but it's simply not going to happen. It's politically unattainable. So the next best solution is for the Fed to go out and do these asset purchases. You know, it's not a perfect solution. I don't think the Fed really wants to do that, but they've seen inflation trending lower this year. You're seeing the unemployment rate remaining too high. Obviously, growth isn't strong enough to push that unemployment rate down. So the Fed really has to do something, and you know, this isn't, you know, quantitative easing. It really isn't something that the Fed has pulled out of thin air. I mean, this is textbook stuff. I mean, people have thought about how to get out of a liquidity trap for a long time. Yeah.
Right, Scott. Does that tell you though that the Fed has to do even more than what they've announced?
I think many people were disappointed that they didn't do more. I mean, the Wall Street was originally talking about them doing a trillion. They certainly left the door open to do more, maybe even a little bit less, but possibly more depending on how things develop. I would suspect that we're going to see, you know, some restraints on growth, and not over in terms of the economy, but in jobs in the first half of next year.
Right.
But still at this moderate pace, and then sort of picking up more in the second half of the year. But there's still a lot of uncertainties at this point.
Scott, I know you've said this. I believe you said this. Hugh, I'm not so sure as well. But you know, these Bush tax cuts, extending these Bush tax cuts, if they were extended at least for a year to 3 years, is that going to change the economic outlook then for 2011?
Well, I think the outlook would you know, would remove one big level of uncertainty at this point. You know, raising taxes in a soft recovery, you know, it's just not a good idea. We can talk about sort of the composition of those tax cuts. I think the middle class tax cuts would be much more effective. But even including tax cuts at the higher end of the income scale, I mean, that's going to be supportive of the economy.
Right, but doesn't this number show that something like extending the Bush tax cuts is more necessary, Hugh?
Yeah, absolutely.
Oh, I think so. Yeah.
Scott's absolutely right. That's the good news here. This is likely to end that debate and really mean that the Bush tax cuts are going to be extended for at least a year, probably 2 years. In other words, there's going to be an emotional political reaction, just as there's going to be a somewhat emotional financial market reaction. So that's the good news. There's actually good news, but you have to look out beyond the knee-jerk reaction, or look beyond the financial market reaction today.
Hugh, Scott, thank you so much for joining us. I really appreciate it. A lot to talk about with this jobs report. That was Hugh Johnson, our Bloomberg Best economist, as well as Scott Brown, another Bloomberg Best economist on jobs.